Welcome to today's Explainer. We're diving right in to decode the cutting-edge innovations and, the very real financial realities driving some of the most fascinating high-growth tech stocks on the market today. We're looking at the big players, the wild moonshots, and pretty much everything in between. Here is our roadmap for today. We're covering 1. Products over just numbers. 2. Big tech's next pivot. 3. The space tech ecosystem. 4. The quantum computing frontier. 5. Fintech's volatile rise. And 6. The AI hardware monopolies. Think of it as a journey up the risk-reward ladder. We'll start with foundational big tech, launch into space and quantum moonshots, and then ground ourselves with fintech and AI hardware monopolies. Let's get started. Section 1. Products over just numbers, the secret to massive growth. Before we look at any specific company, we have to start with a core investing philosophy. Massive market growth happens when a company builds the absolute perfect product just before the market fully appears. Look, traditional stock numbers and past performance absolutely matter, for sure. But focusing on transformative products, that's what actually reveals those future markets. It's exactly how a $10,000 investment in AMD 5 years ago turned into 60 grand, or how Palantir spiked to 160,000 in just 3 years. It's literally all about finding that untapped potential. Moving on to Section 2, Big Tech's next pivot, Microsoft and Broadcom. Let's see how the established big tech players are responsibly navigating this crazy market volatility, and more importantly, how they're strategically pivoting into massive new infrastructure. Now, Microsoft is doing something really interesting with their focus. If we break down the underlying numbers, they're expertly offsetting a 1% drop in their consumer PC division by aggressively expanding their business-to-business segment by 17% and their intelligent cloud business by an unbelievable 30%. And that strategic B2B shift perfectly explains this massive number. Microsoft is planning a staggering $120 billion AI infrastructure spend in 2026 alone. They're basically treating AI like grocery store eggs, right? It's a massive loss leader designed to get enterprise customers in the door. Because once they're inside using the AI, well then they buy those highly profitable Azure cloud services. This next bit brilliantly illustrates the power of cash in the tech world. Broadcom is sitting on a mountain of it, nearly $15 billion in cash reserves. They use that incredible liquidity to partner up with firms like Blackstone to fund massive 20-gigabyte global AI deployments. And the best part? Those massive data centers ultimately require Broadcom's very own networking gear to function securely. Talk about a win-win. Broadcom is basically the ultimate picks and shovels play, and they're flying completely under the radar. What really jumps out is their incredibly low forward PEG, or price/earnings to growth ratio of just 0.77. This essentially means it's valued far, far lower than its explosive 200% year-over-year AI revenue growth would suggest. So despite completely dominating secure zero-trust networking, they are highly undervalued right now. Section 3. The space tech ecosystem, trillion-dollar orbits. Let's step a bit further up the risk ladder now, moving from established tech into a totally new ecosystem that's really just hitting maturity, heavily driven by a huge recent surge in commercial rocket launches. According to a 2024 McKinsey report, the space industry is projected to reach an astronomical $2.5 trillion per year by 2035. This sector is gearing up to be one of the fastest-growing technology markets of the whole decade. It's creating an entirely new ecosystem, kind of like how the early smartphones spawned that massive trillion-dollar app economy. Now, for those of us wanting broad exposure to all this growth, there are 2 major space ETFs to consider. On one side, you've got the newer WESB ETF, which leans really heavily into direct space plays. We're talking about roughly 23% held in SpaceX and big stakes in Rocket Lab. On the flip side, the ARC-X ETF is much broader. It holds under 10% in SpaceX and instead captures adjacent defense innovations and tech like 3D printing. Section 4. The quantum computing frontier, beyond classical limits. Okay, moving from outer space all the way down to the subatomic level, let's explore the quantum computing frontier. This is a market expected to hit $170 billion annually by 2040, and it just got seriously accelerated by a massive $2 billion U.S. government investment. IBM is making some serious waves here, securing nearly half of that government funding. They're dominating the ecosystem not just through cutting-edge hardware, like their super reliable Majorana 2 chips, but also through software. Enter Qiskit.
It's the world's most popular software development kit designed specifically for programming quantum computers.
And honestly, the developer adoption just brilliantly illustrates their dominance. With over 13 million downloads, IBM's Qiskit has captured a whopping 69% of the developer market. They are effectively locking the global enterprise community into their specific ecosystem right now, well before quantum computing even hits peak commercial viability. Section 5. FinTech's Volatile Rise, the SoFi roller coaster. So from the theoretical timelines of quantum mechanics, let's ground ourselves back in the highly volatile immediate reality of modern fintech. Take SoFi, for example. They've seen their stock drop 37% year to date. But here's the thing, it's not because of bad products. It's because of these three macroeconomic steps, starting with that massive 2020 deposit surge, moving to the explosive $1.5 to $2 trillion private credit market today, and anticipating future rate hikes. All of this exposes them heavily to systemic risks in those interconnected lending and credit markets. But here is the core takeaway for the long term. Despite that crazy macroeconomic roller coaster, SoFi still boasts a 30% compounded revenue growth. Their grand vision: to become the AWS of modern finance. And they're doing this by building a powerful dual engine. On one side, they provide highly rated consumer banking and massive lending volume. On the other side, they provide critical enterprise infrastructure through their Galileo platform. Section 6. The AI hardware monopoly, picks and shovels. Finally, let's look at the ultimate hardware bottlenecks. These are the absolute foundational companies that physically manufacture and test the actual tech enabling this entire AI revolution. Get this, Teradyne trades at a staggering 63 price-to-earnings, or PE ratio. That massively outpaces the traditional 23 PE average we usually see for hardware companies. Why? Well, Teradyne makes the absolutely crucial testing equipment for AI chips, and they also happen to own Universal Robotics. This dual dominance completely explains why the market prices them at such a massive premium, even when you factor in the inherent cyclical risks of the semiconductor industry. And actually, speaking of those cyclical risks, history shows us the semiconductor market goes through roughly 5-year cycles. After the last downturn in 2023, Teradyne is facing a potential cyclical downturn around 2027 or 2028. The big question we're all asking is whether that potential drop will just be entirely offset by the massive, totally unprecedented AI infrastructure spending boom we're sitting in right now. Which brings us to a company so critical that Elon Musk personally visited them just to discuss the future of chip manufacturing. That company is ASML. They have a borderline monopoly on extreme UV lithography machines. Basically, these are devices that literally use lasers to write with light, etching the most advanced and powerful chips in the world. It's like something straight out of sci-fi. Because of that absolute monopoly, ASML can charge an astonishing $400 million for just a single next-generation machine. That is true monopoly pricing right there. But, it's a price tag easily absorbed by their clients who just so happen to boast multi-trillion-dollar market caps and desperately need that computing power. We've definitely covered a lot of ground today, and we've seen how focusing on transformative products over purely historical numbers reveals the very companies actively building our future infrastructure, as AI, space exploration, and quantum computing completely redefine our economy. I want to leave you with this provocative question to consider. Is your portfolio invested in the past or the future? Thanks so much for joining me on this explainer, and keep learning.